All right. I'm excited to have Don Wenner, the CEO of DLP Capital Partners, back here with us. And we're just going to do a short video today and talk a little bit about real estate, particularly private real estate and the funds that are offered through DLP. Don, thanks for being with me today.
Hey, thank you, Jim. Really excited to be here.
Now, a lot of people are really bummed out by our low yield environment these days. I'm getting all kinds of crazy ideas by email that people want to do because yields are so low. The most recent one involved some scheme involving options where they were trying to make, a yield of 24% a year using cash secured puts, I think it was. Money market funds are paying nothing. Maybe you make 2% in bonds or CDs or annuities. And yet you offer a real estate debt fund backed by loans in first position that essentially pays 10, 11, 12%. Why aren't more people investing in it?
That's a question I asked myself a lot in our early days of doing this. We've been running this fund and this strategy for 7+ years now, and I'm excited to say more and more people now are. And we just had a record-breaking quarter and welcomed around 200 investors to our lending strategy alone. But it definitely is a mystery to me when you look at the world of debt and people often think of bonds as the only or the most logical place to invest in debt. And that's really, why I always think of bonds as just a form of lending money. And when you think of bonds or CDs or some of these other fixed income vehicles, the yields frankly don't make sense for hardly anyone to consider today. And when there's great investment vehicles out there like our lending fund, our fund produces well over double-digit returns, as you said, Jim. But there's other good vehicles out there producing high single-digit. It's hard to make sense of some of the traditional lending vehicles in today's market.
Yeah, I mean, even on your equity side, on your equity fund, the housing fund, the DLP housing fund, the yield on that is what, 5, 6, 7% in there as far as the income?
Yeah, that's the monthly cash flow is 6%, or in other words, a 0.5% dividend every month, 6% a year. And then we have annual distribution of realized and unrealized gains with a target of over 12% a year, which we've achieved the target in every one of our funds each year.
Yeah, but even someone looking for income, you're getting pretty decent income off that, right? People start looking for high dividend stocks that pay 3%, right? And they can get out of real estate not only a higher yield, but a yield that's covered by depreciation. And so
Exactly.
after tax is dramatically higher. So I find it fascinating that people who want yield, and not necessarily that everybody should have, a big part of the return coming as yield, but for those who do, it's amazing to me that they don't look more into real estate.
Agreed.
Let's talk.
I think you hit on a lot of there with the tax side is, earning 6% without any of it going out in income taxes on an annual basis being deferred through, as you said, depreciation. That's a big difference from a lot of other forms of income producing similar returns.
Now, part of the reason you earn more than bonds is you're taking a little bit more risk. Let's talk about risk. Let's talk about some of the main risks for a passive real estate investor and what they can do to minimize those.
Yeah, so when it comes to I'll talk specifically to DLP, and if you want me to get in a broader sense, happy to do so. But specific to DLP and our lending side of our strategy, I'll start there first. As you said on the onset, these are first position loans backed by real estate, and on average, we're just 54 to 55% loan to value. And our average borrower is a full-time professional real estate investor with a 700 plus credit score, 3 million plus in net worth, and more than 50 real estate deals under their belt. Since COVID, we haven't had a single loan in a year now, a single loan go 30 days delinquent or more, or go into forbearance, not a single loan. So despite just having one of the most volatile and interesting events, we all have heard about the forbearances on rent payment and all the different challenges related to real estate through this pandemic. Every one of our borrowers made every single payment. So it's a great testament, and we produced 11+% returns, annualized returns every month through this COVID environment. So when you look at our lending strategy, what I think of the risk as the biggest risk we pose investing in our lending strategy is the risk of illiquidity if we were to have an incredible downturn. But I don't consider that risk of illiquidity in most cases actually to be a bad thing. It might not feel great at the moment, but what I mean by that is right now our fund is highly liquid. If an investor was investing in a lending fund today, came to us and wanted liquidity, wanted to redeem their investment, we're generally providing full redemption in a matter of days or weeks. The technical language to our fund documents is 90-day liquidity. If all of a sudden real estate, dropped in value by 50% overnight and real estate couldn't be sold and none of our borrowers could pay off their loans and we had to foreclose on all of our borrowers, we would take back all of the real estate that we have loans against at an average cap rate of over 12%. And what a cap rate is what's your cash on cash return without leverage. So if I was earning a 12% unlevered return as a worst case doomsday scenario, that's not a bad place to be. And so what I mean by that, even in a really tough situation, we're going to be able to produce cash flow to investors. So when you're in really volatile recession environments, cash flow is the thing most people need more than anything. And I feel really confident we'll be able to provide that even in that type of environment, even if there's liquidity issues. And when property values are down, you don't want to sell off real estate. So if that's the kind of the doomsday situation we face, we feel in a really great position in our lending strategy. In our real estate strategy, is a similar scenario that our cash on cash returns across our portfolio is typically north of 10%, double digit cash on cash returns. Again, what COVID showed us and the last big downturn of the 2008 recession showed us is that even in these recession environments, workforce, affordable housing, which is what we invest in, workforce housing that's affordable for the local workforce and remain affordable. When we're in recessionary environments, the demand for that housing goes up, not down. And you look at 2008 to 2011 in most of the United States, all the markets we're in, property values, or I should rephrase that, rents stayed flat or went up while demand went up. Occupancy stayed really, really high. So we feel incredibly strong in a recession environment. Again, we might not be liquid. We might not be able to sell real estate in a really rough environment, but we'll be able to continue to generate great cash flow to investors.
Awesome. Now, on a more broad sense, passive real estate investors, they worry a lot about the manager, which is probably the most important part of selecting any sort of syndication or fund. What the reassurance can you give them, and how should they make sure that the person they're investing with or through isn't going to Bernie Madoff them?
Yeah, it's a great question, and I'll take it a little bit of step back here. So this is the first kind of video or podcast or anything I've done in weeks where it hasn't been about one specific topic, which is this topic here of what's in my hand, which is the book I just published last week, just became a bestseller here, called "Building an Elite Organization: The Blueprint to Scaling a High Growth, High Profit Business." And it's a book on how DLP operates, what we call the elite execution. It's the internal operating system, how we go about developing our organization, prioritizing, communicating, running meeting, hiring, developing leadership, all the internal challenges of growing a business. And this is this operating system not only that we run that has helped us grow by over 60% every year for the past 15 years, but it's also the system that we teach and help implement to the real estate operators we lend to and invest equity with. And what I believe is that most real estate operators, well, first I'll take a step back. Most real estate deals that go bad don't go bad due to bad real estate. It goes bad due to poor execution. And so we really focus on is making sure we're partnering with and we're underwriting managers and evaluating managers, just like you're doing as a lender to them, we're evaluating their ability to execute. And so we come alongside them and helping them in developing their team, hiring, building structure, organization, project management, all the challenges of scale, because we want to make sure they don't get in over their heads. And most real estate operators who end up in a situation where they're, robbing Peter to pay Paul, or the Bernie Madoff terrible situation, don't usually go down that path of fraud on purpose. They usually end up struggling with execution and getting in over their head and trying to find a way out of it. So we focus heavily on making sure we're partnering with great operators, with good ethics, core values, and with a desire to build a really elite, great organization. So we put a lot of time and energy around investing and evaluating the management team that we lend to, that we invest alongside of, because we believe that's equally as important as the strategy that we're investing in. So we all, probably everybody listening here on this podcast, everybody on the White Coat Investor Group probably, believes in real estate, believes in housing as a great asset class. It's hard to argue against housing in this environment. But you can invest in a great asset class such as housing, but with a bad operator and still have problems. So management is absolutely critical, whether that be a private passive real estate investment or a public company. The management team investing in that strategy is incredibly critical.
Now, a lot of people kind of decrease their risk, their manager risk by diversifying. How much diversification between sponsors or between funds do you think an investor needs? For example, if they decided they were going to put a third of their money into real estate, how many different sponsors do you think they ought to be working with?
I don't think there's a right or wrong answer there. What I can say is, if we were to look at, public companies as an example, right, we all know, the big 4 or 5 tech companies out there are generating an enormous amount of the growth of the S&P 500, right? It's a handful of management companies, a handful of companies that are driving and reaping most of the value of this current economy, right? That are outperforming all their companies dramatically. It's a small percentage, and it's not all that dissimilar in real estate, that there are a small amount of managers that outperform most. I mean, real estate is especially in sectors like housing. It's not easy, managing hundreds of residents or thousands of residents, especially in workforce housing. It's a challenging business. It's not a it's these aren't triple net leases in the space I'm in, where a credit tenant automatically ACHs their payment on the first of every month, and it's a coupon. It's a lot of work. It's a lot of execution. So I'm a big believer in how I invest personally for my family trust, and is as I like to partner with great managers that I really believe in and back, and go deep with those managers, invest heavily in them. So I don't know if there's a right or wrong. I certainly think diversification is a great way to mitigate the various risks, such as the Bernie Madoff per se risk, as you mentioned. But I believe in wealth is created through concentration, and so it depends on what your overall goals are. But I think it's good for any investor, especially those really looking to invest passively, to have multiple managers that you're confident in, that you believe in back. They'll make the right decision in good times and in bad times. And then a lot of good managers out there do what DLP does, in that we have multiple different strategies that give you different diversification within a manager in terms of different strategies, different risk position, different liquidity, different taxation structures, different geographies, et cetera.
Awesome. Let's talk for a minute about geography. How important is geography when choosing real estate investments? And if it's really important, what states and what size communities should people maybe avoid or be looking for?
Yeah, I think geography is important for sure. In a great environment like today, the benefit is a lot of markets are doing really, really well. What we think about when we invest, so we own real estate today in 23 states, probably about 50 markets within those 23 states. We lend capital out to in 35 states across about 100 markets. So we have a lot of diversification within the markets we own and lend in. What we filter our investments by, what we focus on, is we want to be in markets that are pro business as a general rule. We want to be in markets that have strong population and strong job growth. And we expect over the duration of our investment that will maintain to continue to be states that have strong job and population, or markets that have strong job and population growth. And we invest in markets that we can get and extract better yields, that are more inefficient. So that means we invest largely in secondary and tertiary markets. There's certainly a lot of value in investing in the Miamis or Atlantas or Charlottes of the world. Those are certainly great markets by many standards, but because they're such big markets, that's where all the institutional capital go, and they extract most of the potential to generate outsized returns out of those investments. We find ourselves largely in the Sun Belt region, states with warm climates that have strong pro-business leadership that's driving in companies and growth, and between that and weather are driving in strong population. We like being in markets with some scale, so we like being in markets with at least 50,000 households. And that largely keeps us in secondary and tertiary markets. So instead of being in Charlotte, we're in Asheville. Instead of being in Miami, we're in Jacksonville, or here where I'm talking to you from in St. Augustine. Instead of Atlanta, we're in St. Simons or Warner Robins, or Macon, Georgia, as examples, or Greenville, South Carolina. Those types of markets. The nicer areas like Germantown, Memphis. So markets that are growing, but aren't on the top of every large multi-billion-dollar public REIT.
Awesome. Well, thank you so much for your time today, Don. This has been an interview with Don Wenner, the CEO of DLP Capital Partners. If you want to learn more and about him and about their funds, such as the housing fund they have, which is their equity fund, as well as their lending fund, which is their debt fund, you can learn more about that at whitecoatinvestor.com/DLP. Thanks for your time today, Don.
Hey, thank you, Jim. Appreciate it.
My dad, your host, Dr. Dahl, is a practicing emergency physician, blogger, author, and podcaster. He is not a licensed accountant, attorney, or financial advisor, so this podcast is for your entertainment and information only and should not be considered official, personalized financial advice.